Hi everybody, I'm Sean Lynch here from Quifa Financial Planners with this presentation on how to get the most from your business. So I'm a qualified financial advisor and a certified financial planner. I'm 35 years giving financial advice and we have offices in Mallow and Cork. We've got 5 staff, 3 of which are qualified financial advisors. We use a team approach and a house view, so there's plenty of backup. So if you have any questions or queries, everyone will give you the same advice, which I believe is very, very important. Our niche is business owners. So we're delighted to having a chat with you as to how to get the most from your business. So today we'll be talking about the financial life cycle, the different tax bands, why pensions make sense, top tips and then pre-retirement and post-retirement. It's important you understand how both of those work, reducing your tax bill, and top tips for wealth extraction. The financial life cycle, this is my favorite graph of all time because it does explain how your life works and the interaction that you have with your money. You can see along the bottom line there, from 25 to 65, that's your life working, your working life, and it grows over time. Your wages grow over time through expertise, experience, and knowledge. You can see the different stages: pre-family, family, pre-retirement, active retirement, passive retirement, care home, and then unfortunately mortality. And this kind of is the general rule of what happens in people's lives. If you look at the blue line, human capital, is the amount of the accumulated money that you will have earned over your working lifetime. So that starts off quite high at the age of 25 because you've got 40 years working ahead of you, and then reduces over time down to 0 because you're now retiring. You can see at age 55 it crosses the black line, and then they've only got 10 more P60s to collect. So if you look at the financial life, the financial capital, a far more interesting one, and that's the accumulation of your net worth. And this is really important because it's the amount of money that you retire upon. So people always ask me, how do I actually retire earlier? And then they say, I just tell them, look, you just need to accumulate more money or save more money, and you can retire earlier. That's quite simple. But you are saving for the longest holiday of your life. And then from the age of 65, there's 3 different types of spending. You'd have your core, which is your basic utilities. You'd have your discretionary, which is your trip around the world. And then you'd have your healthcare, which starts off quite small and then actually gets to quite a high value. So there are 3 different types of tax categories. There's PAYE, sole trader, and limited company. So it's very important to understand where you are at. So PAYE stands for pay as you earn. So there's an employer-employee relationship. The pension can be your contributions only, or company can also contribute. Typical would be 5% and 5%. So 5% from the employee and 5% from the employer. Sole trader, you only pay tax once a year. There's no limit in your name, and no one else is contributing to your pension. It's really important because I remember talking to a guy one time, and even though he was a limited company, he thought that he was a sole trader simply because he was the only one working in his company. But his company name was ABC Limited. That's why there's a limited in your name. Limited is in the title for a limited company. You can manipulate the wages upwards and downwards depending if you're a 20% proprietary director. So that's really important. So you can pay yourself 1,000 one year and maybe 100,000 the next year. So without raising a revenue eyebrow. You're paying yourself, you're on the PAYE system, and your pension is open to employer and employee contributions. But why contribute when you can get the company to contribute 100% of your pension contributions? Why pensions make sense? Very simply, pensions are funded by PAYE employees. So there's 5 PAYE employees now to every 1 pensioner. In 2050, because of our aging population, they reckon that'll be 2 to 1, which is putting huge pressure on the pension system or the state pension. It was 66. They were talking about moving it to 68. It then became a political football and they moved it back to 66. But there are talks of moving it to 70 at some particular point in time. Tax relief on pensions at the moment is currently 40%. So it's tax, and the way pensions work is that it's tax-free in, tax-free growth, and then a percentage paid out tax-free. Wide range of funds to invest with. It's huge, the range. A sole trader can contribute up to 40% of their salary, 40% of 115,000 if they're earning more than 115, it's still 40% of 115. So with limited, there's a new law came out. You can pay up to 2 million less existing benefits through an executive or a company PRSA. Pre-retirement, sole trader is all tax. If you die, sorry, this is pre-retirement death. If you die while you're in pre-retirement, before you draw down your pension, all of the money is paid to your estate tax-free. A company pension can get up to 4 times salary life cover payout, which is a really valuable thing to do. So these are the tax reliefs for different types of for sole traders and PAYE under the Master Trust scheme. So if we look at sole traders first over here, you can see a 40 to 49-year-old can contribute 25% up to 115% of earnings, and a 60-year-old plus can contribute 40% up to 115% of earnings. Under the Master Trust scheme and company over on this side, you can see that a 50-year-old can contribute 216% based on the salary and service of a person. Now, I did mention there's a new scheme after coming in, and basically a company PRSA ABCs, they can contribute up to 2 million into their pension less existing benefits. So this is a real game changer, and it's just new, and it's really, really important. So these are my top tips. A lot of people aren't aware that you can put in up to 2 million per person into a pension fund. PRSAs, beware of the PAYE tax credit of 1,175 that cannot be transferred. Everybody thinks that they can transfer all of their tax credits. They can't. There's one particular one you can transfer, and that means 8,775 in earnings. So calculate your tax using the PwC income tax calculator and know where your money is going. This is a really good, helpful website. So you just put in your income and you can see the split between tax, PRSI and USC. Top tips again. So know about entrepreneurial relief and retirement relief. These are two valuable reliefs when you're thinking about retirement. I'm not going to go into them here, but there's a lot of work that can be done pre-retirement to get the maximum money out of it. If your spouse, partner is working in the business, employ them and employ them. And start for pension for them as well. It's really important that you get the pension clock ticking. Employ your children if they're over the age of 16 and if they're working in the company also. It makes great sense. Top tips again, know your numbers. Really important to know where your money is going, what money is coming in. Really important to know what's in your bank balance. Credit, avoid it if you can. 2008 was a major learning curve for everybody, and people have really tightened up on credit. So if you don't want bad debts, don't give credit. Take the €1,000 voucher for yourself, and if you're giving Christmas boxes, make sure that you're giving vouchers as well, not cash, because cash is coming out of your pocket. Top tips again, so separate bank accounts for business and personal. I'm always constantly amazed the number of people that run their business, especially as sole traders, through their personal account. Not a great idea. Pay yourself from your business to your personal on a weekly or monthly basis, but keep your business account and your personal business separate. That way then you'll always know what the numbers are. Save for the tax man, 20%. So if you are a sole trader, if you're a sole trader, put away 20% of whatever you've earned during the month so that you can pay the tax man. So if you started in the 1st of the 1st, 2022, your first tax bill is going to be October 2023 as a sole trader. 22 months later, it's a horrendous bill, so you need to actually pay the tax man. Contribute the maximum amount to your pension, just based on the previous slides there. You will need to retire at some particular point in time. Think like a civil servant. There are things, this is for company directors who are using their own car, and the same like a civil servant, they would actually get travel expenses, subsistence expenses and overnight expenses. So think like a civil servant and put in your expenses. Know when to move to a limited company. Really important is that limited companies were set up to be more tax efficient. It's important to realize that, but you've got to hit a certain threshold first. Okay, so that's something that we could talk about. So company pension contributions are seen as an expense to the company and reduce your profit. And why would you want to reduce your profit? Because when your profit is lower, you reduce your corporate tax liability. So by reducing your wages, you earn less, you pay less tax, you pay less PRSI, and pay less USC. So it's important that you learn, you extract money, or you're aware of how to actually make the company work for you and not you for the company and the tax man. So a lot of people aren't aware of what happens with USC, but after 70,044 euros, the USC goes from 4.5 to 8%. Another 3% is added over 100,000 for the self-employed. So not great. You're actually nearly at 11. You are at 11% USC once you're over 100,000 as a sole trader. So it's important to be aware of it, and it's important to understand how it works and things that you can do to actually alleviate it. So travel expenses, really important that you understand how the civil service mileage rates, know your rates, and more importantly, know how you can use your rates. The next one is invest company cash. Don't just leave it sit as you are losing money on a deposit account with your company cash. So you can invest it. You can invest it in various different types of bonds and even a high interest deposit account. But delighted to have a chat with you about that. So these are two examples from how people have made money from pensions or how to use the system. So this particular example is limited, note limited. So 16 years service, no pension, age 65, average salary was 100,000, contributed 105 in July and got 100,000 back in October tax free. This is using the salary and service method and using the maximum, what they call the uplifted scale, to get the maximum tax-free cash out. This is possible, and I've done it for a few clients. The next example has got 22 years service, age 66, an average salary of 60,000, contributed 90,000 in 2021 as she's 22 years service, got 1.5 times her salary back as a tax-free lump sum in 2022. There was no residual balance left over as all the money was paid to use up the tax-free lump sum portion. So again, this is just one particular way of actually getting money from your pension using the salary and service method. These are your tax bands, so it's really important that you know them. 40,000 as a single, 49,000 and 31,000 if you're married or have a civil partner. You can split, you can give some of the tax credits to the higher tax earner, but they calculate them out anyway as 80,000 on a joint life basis. So the type of pensions that you can get will be the pre-retirement pension, the post-retirement, the annuity option, and the ARF option. And I'll discuss each one of these separately. So the first one that we want to talk about is the pre-retirement option. So believe it or not, these are the type of pensions that you have in pre-retirement. And by pre-retirement, I mean before you take your tax-free cash. So you've got personal pension plans here on the top left. Then you've got PRSAs here on the top right. Then you've on the bottom left, you have EPPs, which stands for executive pension plans or company pension plans. And over here, you've got buyout bonds. Now, that's all you need to know. That slide is quite detailed, and I don't mean to confuse you. So forget about the arrows, but just have a look at the different types of pension that you can have in pre-retirement. So these are the type of pensions that are available after you take your tax-free cash. So when you take your tax-free cash, you change the nature of the contract. So then you can have an annuity, an ARF, or a trivial pension. And more about those later. So with the annuity option, there are two different ways you can take it. One is a company director and the other one is a sole trader. So item number one, take a tax-free lump sum and the balance to be used to purchase a return for you each year until you die. That's really important. It's every year it's going to be paid out until you die. Salary and service method for limited company owners only. 25% for sole traders. 25%. So if you've got 100,000, you can get 25,000 tax-free cash as a sole trader. The salary and service method we discussed earlier, and that's where they had no pension and they used up all of their money as a tax-free lump sum. With the salary and service method, after the residual, then a rate is struck, and that is paid out yearly until death, and you can include your spouse on a joint life last death basis. A typical annuity rate for a single female over 65 with a pension amount of 100,000 is actually 5.32%. So that means that they'd roughly get 5,300 every single year until the day they die. So the advantage of an annuity is that there's a guaranteed payout for life. There's various options. There's guaranteed term. So joint life last death, most popular for married couples, best suited for people with longevity in the family and no further investment decisions. The disadvantages are you cannot control the flow of income, funds die on death unless joint life last death basis, and no option of increasing monthly income if market increases. So the approved retirement fund, you can take 25% tax-free cash. The balance to be invested in a ARF. ARF stands for Approved Retirement Fund. The minimum drawdown is 4% per annum at 61, moving to 5% at 71. 800,000 of pension fund will give you 200,000 tax-free, and the balance then will be invested into a fund. Now, it's not a guaranteed fund like the annuity. That's really important. It is a fund which the markets can go up and can go down as well. The advantages of this is that you can control the flow of income, so you can take more if you want. You can invest in funds of your choice. You can make more money if markets outperform, and you can decide the percentage of risk level in the appropriate fund to match this level of risk. The balance of the fund can be left to the estate on death, i.e. the money can be left to somebody on death. You could lose money if markets don't perform as desired. That's a disadvantage. The funds could run out. Now here's the really big one. The funds could run out depending on the rate of return. So think of it like a deposit account, and if you're drawing money down, if you take a lot of it out, then you're going to empty it a lot faster. So we have strategies to try and maintain that, and we do a lot of work around that for our clients. So ongoing decision making in relation to investments, that's really important. You need to continue to keep it updated. So in conclusion, what's next? So the next step that you should be taking is having a chat with me and the team here at Quifa Financial Planners. We'd be delighted to have a chat with you and just to kind of discuss how we can help you and help you save money and get your finances in order. So our process is, the discovery process is gathering all of the financial information, and then we look at your lifestyle and financial goals. We do some risk profiling just to see what level of risk you can take, and maybe a bit of cash flow modeling to kind of show you and project out your income and expenses into the future. A discussion on options and then tax implications. Tax is really important. And then we do our research, and then we come and we make recommendations to you and we implement those recommendations. And then of course the important piece is the review and monitoring. So this is a very simple example of a cash flow modeling. So we use a software called Voyant. Voyant is from the French verb to see into the future. And this guy has a lot of income, but no income after he retires. So very simply, blue is good, red is bad. So he's in deep doo-doo here when he retires because he's not planning for his future. And we can demonstrate this in a very clear and simple format. So this is the after. This is after we've worked with him for a couple of months and we've rectified that situation. And as you can see now, he's running out of money when he reaches approximately 85. So that's really good. So blue is good, red is bad. That's a very simplistic example of the work that we do, but it's actually making sure your finances are in the correct position. So we're on the home straight. We've only got 3 more slides to go. And the way to get started is to quit talking and begin doing. Do something about it. Don't just leave this slide again. Hi, so time to meet the Cuifa team. We've got Tom Dawson, QFA, Aoife O'Connor, QFA, Qualified Financial Advisor, Ola Regan, APA, the soon-to-be QFA, and then I'm here down the bottom as Sean Lynch, QFA, and I'm also a Certified Financial Planner. So, congratulations, well done, you've come to the end. You have a basic idea what's involved and how you can save money as a sole trader and a limited company. We'd love to help you put it all together and create a bespoke financial plan for you, where you can see your cash flow modeling going right out into the future, give you certainty and clarity about what your financial future will be, and great tax saving tips. You can contact the team here or contact me on the Cuifa on 022 57444 or info@cuifa.ie, and our website is cuifa.ie as well. So that's great, that's the end of it. Talk to you soon. Love to hear from you.